Good morning, traders and investors. It's July 6th. It's Wednesday, and my name is Roger Scott, and I'm the senior strategist of Wealth Press. It's about 8:15 in the morning. The market's going to open up in about an hour and 15 minutes. We've got some data coming out today. I'll get into the report, but remember, folks, at 11:30 today, Lance Ippolito, Jeff Zananeri, and myself, we're having our weekly roundtable. It's happening at 11:30 a.m. Eastern Time. Don't forget to follow the link below, sign up for that session, and get a link. It's free, doesn't cost anything, and we're going to talk about market action. So, as you could see here, and I'll remind you before I finish this video as well. So as you can see here, the NASDAQ is down about 70 points. The Dow's down about 100 points. Yesterday, the NASDAQ rallied pretty hard, and the NASDAQ and the S&P and the Dow followed along pretty well. At one point, we were down about maybe more than 500 points, but we recovered pretty good and closed down less than 200 points, while the NASDAQ and chip stocks were positive. As a matter of fact, if you look at some of the chip stocks, you will see that they have been gaining strength. And when you have semiconductor and other chip stocks starting to gain strength and energy stocks starting to move a little lower, that's not a bad sign. Speculative stocks bottoming out is a very strong sign that this market may be in play. Another major sign that this market may be in play is the fact that the bonds, the long bond, continues moving higher against the main trend. Now, if we can break above this level here, which is the 120, we will become grossly overbought. And if we become grossly overbought, I'm going to be selling this. But I need to see the price level go to a specific level, and I need to see it go to about the 120, because I think that it's going to revert lower, because ultimately interest rates are going to go higher. But right now, this is giving the stock market some relief, especially some tech stocks. As I showed you guys the other day, if you look at Crocs, for example, I'm just showing consumer stocks. If you look at Crocs, you will see, notice that, sideways. Look at Amazon. It's taking on the shape of the bond market. See that? Down and then choppiness. And then look at the bond market. Same type of trading action. So the longer the bond market can stay choppy, the more it can maintain choppiness and less pressure off of the stock market. And the stocks you want to pay attention to right now, and I'll get into sectors, are definitely chip stocks, because they rallied yesterday when the whole market faltered. Really, really, really important. Now the market's opening the market is going to be opening down a little bit lower today. But let's look at the global news and see what's happening. Global shares were mixed Wednesday as European benchmark rose in early trading despite looming worries about global recession that pushed the euro to a 20-year low against the dollar. Global economy is just pushing this market into a recession, or it looks like we've been in one already for about a quarter. Oil prices recouped some ground. The dollar surged, and the reason the dollar is surging, folks, is because you're buying less with the dollar because of the inflation. So the dollar rising is just to compensate for the inflation. The dollar has surged as the Federal Reserve has embraced a more aggressive approach to taming inflation, widening the gap between interest rates in the U.S. and lagging rates in Europe and Japan, where the European central banks and Bank of Japan are adopting a more cautious stance, which is about time they do that. Worries have deepened with European Commission Chief Ursula von der Leyen, maybe I mispronounced her name, saying the 20-nation European Union needs to make emergency plans to prepare for a complete cutoff of Russia gas in the wake of Kremlin's war in Ukraine. And this is going to impact energy prices and food prices. I think, honestly, energy is going to be inflated till this war is behind us, and we don't know how long that'll be. U.S. benchmark crude gained a little bit. We're now back to being above $100 a barrel. It sank almost $9 on Tuesday after settling below $100 a barrel for the first time since May. And international crude was at 104 per barrel. Japanese parliamentary elections coming this week, but expected outcome is for more stability. Lockdown in China from rising COVID cases has also made supply chain problems worse. Now, here's the interesting thing about that. Residents of part of Shanghai and Beijing have been ordered to undergo further rounds of COVID testing following the discovery of new cases in two cities, while tight restrictions remain in place. So just as we thought things were getting a little better across the world from COVID, it doesn't seem to be the case. Things are It looks like things are still in the uncertainty level. Now, what is really positive? Let me show you guys something really positive here. If you look at the Dow, you will see that the Dow made right here, made a swing low on the 17th. But if you look at VIX, if you look at the volatility level, that has not been the case. Volatility is lower than the high on this day right here. So volatility has been holding steady, and if the market starts regaining composure again or regaining strength, volatility will weaken out. Now, today is Wednesday, and Wednesdays I always talk about sectors. So I want to give you guys my sector view, and let's look at it on a visual basis. Energy looks like it's really bottoming out. It doesn't look like it wants to go down anymore. So even if it is going to go down, I think it's going to come up for a bounce. So we can expect some heightened prices. Consumer staples took a little dive yesterday, but they closed up pretty good. So I like consumer staples. Utilities, I don't know what's going on with utilities, just a lot of volatility. But I really like healthcare and consumer staples right now. Take a look at how nice and strong these are looking. They also don't have a lot more upside to go till we meet the next resistance level. But out of all of these sectors, in terms of strength, I like healthcare. I like consumer staples a lot right now. Financial looks like it's building a base. Industrial looks like it's building a base. Real estate looks like it's building a base. Technology looks like it's building a real nice base. Communication services looks like it's building a base, and consumer discretionary looks like it's building a base. And consumer discretionary actually rallied really hard yesterday, even though the Dow went down. So to me, it looks like the majority of stocks, except for utilities and energies, are basing out right now, and they look like it can go a little higher. Now, if we can get above to this previous resistance level on the healthcare and on consumer staples, I'll be pretty happy. But we need to go to about 75 level on consumer staples, and we need to go to the 133 level on healthcare. But I'm predicting these are going to remain the strongest sector till we get some clarity from the market. Again, I also like the technology right now. I like how it's basing. I like the communication services. I like discretionary. They look like they're building a base. Now, if we break this low right here, not going to be a happy camper. But right now, I like the basing. I love the basing on real estate, industrial, financial, discretionary, communication services, technology. Now, materials, basic materials made a new low. I don't know what that's all about. But for right now, I would be very cautious with energy, utilities, and materials. So utilities, basic materials, and energy, that's where you want to be real gentle with right now. But I like the other sectors, and there's some nibbling going on in the tech, consumer discretionary, and I'm really liking that right now. So we may want to stay with that flow. Keep your eye on consumer staples and healthcare. I think they will rally. Those are the two sectors that I'm really liking right now. Now, out of stocks within those sectors, so let me just show you the stocks that I like. So out of the consumer staples, I like Lamb Weston Holding, right? Lamb Weston Holding, consumer staples. And for healthcare, I like Lilly and Merck, those two. Another consumer staples, Dollar General. So you've got, there's a couple here that I like. Remember, there's 500 stocks here. So consumer staples, let me just throw out a couple at you. Kellogg's, General Mills, Dollar General, Lamb Weston. As far as healthcare, I like Lilly, Merck, and we got Bristol Myers. Those are great stocks. You can't really go wrong with any of those stocks. They're all doing really well on my list right now. I would be very cautious, as I said, with energy right now, basic materials, and utilities. Volatility's picking up and they're not moving anywhere. So I'm very cautious on that right now. Now, we got to be careful. Here's the other reason you got to be careful of energies. On a cumulative basis, it's number one. On a monthly basis, it's the last one, and basic materials is behind it, but look at consumer staples and healthcare. So on a cumulative basis, consumer staples and healthcare are still up in the top four, and on a monthly basis, they're at the top. So you really can't go wrong with consumer staples or healthcare right now, and I gave you the top stocks. Now, in terms of the bottom stocks, let's look at the bottom stocks. I don't know if we can find low cost energy stocks. I would right now, if I was a betting man right now, I would lay off the weakest stocks right now because we're going through a sector rotation. But if you want to know stocks that I'm really not liking right now, I'm still not liking the cruise ships. I haven't liked the cruise ships one time, or maybe once I covered them since COVID started, but I'm not a fan of the cruise ships. So Norwegian Cruise Line, let's see, Royal Caribbean, those are just no-nos right now. They're not getting any love. They're not getting any aid from the government. Things are not good for them. Now, right now, you want to watch a few things. You want to watch this bond market. If this bond market continues moving higher, it means there's a chance the Fed is realizing that this inflation already may be well behind us, and they may be going too fast, too quick, and they may slow down for the foreseeable future and give the bonds market a little relief, which would give relief and time for tech and consumer stocks to regain some strength. That's what I'm hoping for. Keep your eye on this bond market, and if it keeps going higher, that's good for stocks. Keep your eye on volatility right now. It's very, 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 very effective. And if it continues moving down and not goes up here, that's a very strong sign. And most importantly, keep your eye on these sectors. If they start breaking lower, like materials is doing, that's not a bad sign. I'm hoping they can maintain this building block right here that we're seeing across the board on everything except basic materials. Energy, actually, funny enough, we're seeing it on energy too. We're actually, the only sectors we're not really seeing it on, or the weird one is the basic materials sector. That's a real wonky one. Now that I look at consumer staples, it actually isn't looking that bad. So the only one that's giving me a real pause here is basic materials, because it's breaking the low. Nothing else is breaking the low except that sector. Energies is not breaking the low, and energies looks like it's going to bounce up. Utilities looks like it can come up some more. I don't know what was up with the other chart, but this chart actually looks much better. So scratch what I said on the stocks that I'm not like, on the sectors that I'm not liking, except for materials. Materials breaking the low, I don't like that. Everything else is holding steady. If it can hold steady, we can go higher. Now, before I let you go, and remember, if you want to get my top play, make sure to join myself, Jeff Zananeri, Lance Ippolito at 11:30 a.m. today. You don't want to miss out. It's going to be a lot of fun. We haven't seen Jeff on there in a couple of weeks. He's been in Egypt. We're covering what to expect from the FOMC meeting today. If it's time to jump into tech stocks, potential winners if Chinese tariffs go away, much more. There's a lot of global stuff to talk about, a lot of local stuff to talk about. We've got earnings starting up again pretty soon. You don't want to miss out. It's happening at 11:30 a.m. Eastern Time today. Follow the link below. It happens every Wednesday, 11:30. It's going to be a lot of fun, and you guys will get a perspective from all of us. Talk to you later. Follow the link. If you're watching on YouTube, go to the Wealth Press YouTube channel, subscribe to it, and it's right there. Bye, guys. See you later. Love letters, comments. If I've been keeping you out of trouble, let me know. Bye.